Hello everybody, welcome to Friday, another Talk Money with Tom show. Super excited to have everybody here today. We, on this show, try to help people have a more successful retirement. We do that through answering questions. So feel free to send in your questions now if you'd like. You can send them into the email address, asktom@talkmoneywithtom.com. We can send that in actually anytime if you want to give us some time to prep for it. But you can send them in now. You can go to the chat portion of the channel here and put in a question if you have it, and we'll try to answer that also. And of course, we always answer questions that come up in our strategy sessions with our clients. So looking forward to being able to try to help you with that. We feel that the more you understand, the more educated you are about retirement, the more you have a better chance of having a better retirement. This particular channel is designed and really focused on retirement planning, asset management, and tax planning. And so if you want, you can subscribe to the channel. We have over 900 videos on there now. You can go on and see if there's some things that help you. And then obviously, if you subscribe, you can hit the little bell button. You'll get notified when we put new content on there. So something we're really proud of, just trying to continue the education process here about retirement. The last thing, of course, is you can set up an appointment if you'd like. You go to our website, which is linked here on the channel. You go to the top corner, you'll see a button looks just like this, book appointment. Push that, pick a time that works for you, 30 minutes, video, phone. You can meet with Ethan and I, maybe some custom questions, some things that, specific to your situation that we might be able to answer. So very excited. I hope everybody gets something out of today's show that they can use and whatnot too. So we'll get started here. I do always like to start with a summary of what I saw happening in the market this week. So this is the S&P 500 chart for the year so far. We can see obviously we've had a downward motion going on, lots of little run-ups in there. That blue line is the 200-day moving average. That's coming down a bit. But if you look what's happened right over my shoulder here, these green boxes, that's this week. It's been a very good week altogether. A good day today. We're kind of having a bounce off of that low that we hit last week. And so that's a really good sign. Now, one of the things I'm going to talk about today is very different. This is not something that I've talked about before, and that is the fact that we're actually reducing our stock market exposure into this upturn. So the market's going up right now, and we're taking that, taking money off the table, so to speak. We're trying to get a bit more conservative, and I'll show you why here and kind of what I see. So first of all, it's important to understand, in my opinion, the different types of markets on the downturn that we deal with, and when you want to get defensive and when you just want to stay in there. And so if we look here, the 5 to 10% downturns have happened 84 times since World War II. So basically more than once a year. That's pretty common. Average return time to get back to the high again is 1 month. Not a big problem. 10 to 20% has happened 29 times, roughly every 3 years. Takes about 4 months to get back. Okay, so I kind of draw a line there. And basically the way that I've handled investing with the clients, and something that everybody should probably think about, is extremely difficult to kind of get in and out of the markets and try to get defensive when the average recovery time is only 4 months, because it's very easy to then get out and get back in at some higher point. And so from that kind of 0 to negative 20%, what we really want to do is focus on how much stock you have. So are you 100% stock portfolio, 10%, 60%, what is it? And essentially then we just take, and so let's say it's 60%. We'll leave it at 60, and we'll move around a little bit within that 60 to try to find different trends. And if the market is kind of going sideways like it has been or down, then we'll rebalance. And we'll use those strategies until we get over 20% down. Now we're looking at 9 times between 20 and 40%, a 14-month recovery, which isn't terrible, but obviously a lot longer. And of course, the big three, 1973, 2008, 2000, sorry, didn't get them in order, but over 40% down, 58-month recovery. And so those are the ones we have to be careful with, in my opinion. If you're going to focus on anything about getting defensive, I would be really looking at those bigger downturns, and that's always been my mantra. I'd rather stay in all the way through. So that's essentially what's happened so far. We're just past at the low point here. We got just past that 20% down, and we're really in this category where there's 9 of them since World War II. And let's, look at now the difference between kind of that negative 20 and that negative 40 and negative 40 plus is recession. So if there is a recession that's going to happen, we're probably going down a lot farther. And so then we want to look at all the indicators that are kind of showing us recession. So, of course, one of the main ones that I follow is the leading economic index. I've presented this multiple times, probably tired of seeing this chart. The blue line is the leading index. The gray line in there is the coincident index. That just means that it's basically the current economy. And so if you look here right above my head, you can see the blue line has peaked out, right? It's coming down a little bit. Even though the gray line, the economy is still going up. And these big bars that are in here, these gray bars, are recessions. And so if you look closely at this, goes back all the way to 1960, that leading economic indicator peaks out prior to these recessions very regularly. And so great indicator of when a recession might be coming, and combined with what's happening in the stock market, you can make some decisions here. So my basic decision-making process is if the leading economic indicator is down more than 1% from its high, it's not right now, but very close, 0.9%. If the S&P 500 price is trading below its 200-day moving average, which it definitely is, and the 200-day moving average is going down, those 3 pieces. If you go back to 1960 and look at those 3 occurrences, those are times to be careful. I look at it like, we're sitting on the edge of a cliff. Things could work out. We might not fall off the cliff, but this isn't a time to dance around. This is a time to be more conservative. And I think pulling something off the table here makes sense to me, just in case, that this should fall off the cliff. And so really, here's some of the things that are part of the leading economic indicator. There's 10 of them. There's 2 big ones that are pulling it down. Number 1 is consumer sentiment. This is a University of Michigan survey where they go out and ask people what they feel about their finances and how they feel it might be in the next 6 months. It just got released today. It's currently at 50.00. That's the lowest it's ever been, going back into the 1950s. So consumers as a whole and households are healthy. They're still buying, although we did see some decrease in retail sales in May, but their outlook is very, very negative right now. And you can see why. Going to the grocery store, going to the gas station, paying more and more and more, and their incomes aren't going up. Their stock balances are dropping, their 401ks are dropping, those types of things. And sort of, a time frame that feels a little bit miserable. And the reason that this particular indicator is one of the 10 indicators that the Conference Board chose for this leading economic indicator is because it's as people start to think more and more negative about their situation, they start to hunker down and not spend as much money and what have you too. So that's one thing I'm looking at that is somewhat concerning. And then the other one that's drawing this leading indicator down quite a bit is building. And so this is U.S. building permits. So this is sort of a leading indicator of building process, right? Got to get the permits. It's not the very beginning, but it's before they're sold and all those types of things. That peaked out in January. If you look at housing and new housing construction in the U.S., I think it's the biggest, most impactful industry in the U.S. Technology is huge. It makes a lot of difference. Technology, though, is kind of white collar. Housing and building homes is all collars. I mean, you've got bankers, you've got mortgage brokers, you've got realtors, you've got trust officers for transfer of property, all those type of things. You've got construction workers, you've got contractors, you've got interior designers. It's unbelievable. Landscape architects. It just keeps going. It is out there. It's really, really impactful. So if housing is coming down and new homes are coming down and what have you, and one of the main reasons is because mortgage rates, right? So mortgage rates have more than doubled really just in the last 6 months. And so we're seeing, the cost of buying a new house is going up because now we get a 6.25% mortgage or something instead of paying 3% like we were. And so between what the leading economic indicator is showing, the stock markets, motion and what have you, this consumer sentiment, and then this, the housing market. Those are areas that are starting to kind of creep in and create some concerns for me that we might be heading towards recession. But probably the biggest concern by far, and this isn't as quantifiable, but it's really the Federal Reserve. So if you look at what happened, I presented this last Friday, but it's still worth noting. This is core inflation. The CPI, Consumer Price Index, was reported, and it came out. That's everything, includes food and energy. Core takes out food and energy. Core inflation is what the Federal Reserve always talks about because they don't feel like they can control food and energy. Core inflation went down in the last report, has been coming down since March. They feel that's where they can make their control. They were going to raise rates 0.5%, and they raised it more, even though core inflation went down. And they're reacting to what we call top-line inflation, which is including food and energy. So what they're trying to do here is raise interest rates to a point where they can get the cost of gas and food to come down. I think they could get lucky here. That could happen, but it probably takes a recession to really make it happen if they don't get lucky. So that's, to me, a dangerous position. They haven't changed any of their rhetoric. Chairman Powell 2 times this week was testifying in front of Congress and essentially said multiple times they'll do anything to bring down a recession, right? So what they're looking at there, they don't have full investment in employment. Their own report shows employment going up, unemployment going from 3.6 to 4.1. So they're looking to create a scenario with higher unemployment. And obviously they're looking, in that sense, they're going to create a scenario potentially, in my opinion, for a lower stock market. So we're fighting the Fed. The Fed is pushing and pushing and pushing on the economy to the downside. There is some potential for consumers to spend enough to offset, but the consumers are fighting the Fed also. And the more they spend, the more they push, the more the Fed will push down on by raising rates, lowering the balance sheets that they've got, and what have you. So an awful lot of things are playing in here. Again, these are side of the cliff issues that we're sitting on right now as we speak. So it's just something I need to be a little bit careful with as far as that goes. Now, the other part, that the last piece here that has kind of motivated me to get more conservative, is just literally the price action of what's happening on the S&P 500 or the market in general. So if we look here, this is an ETF, and it is one of the most highly traded ETFs in existence. It's a SPDR, which is owned by State Street. S&P 500. They try to replicate the S&P 500 here. The ticker symbol is SPY. And so this chart's a little bit different than the first one I shared because you have this big green blob above me, and you can see what that is. It's called a volume profile. So every one of those bars on there shows how many shares were traded at those prices. And so you can use this to look at support and resistance levels. And one of the problems we have right now is where the price is right now, there's a tremendous amount of green above us, which just means that there's a lot of resistance. As the price gets back to that level, I'll show you one here, for example. Today we are at a resistance level. Now that was support. A few weeks ago you can see the market was bouncing off of that and bouncing upward. Once we fall through, support becomes resistance. And so we're right at resistance right now, which is, again, one of the reasons I'm taking profits off the table with this particular run, as far as that goes, because of that resistance that's sitting right there. And the next resistance and then volume, which is right here, has also fallen this week, right? So we've got a nice run up on low volume. It's a holiday week, so to speak, a 4-day week. Maybe, we see a situation where the volume picks up next week, but low volume, high resistance above, all the other economic issues that we're dealing with, and the leading indicator down 3 months in a row. I'm looking at that and thinking, okay, that's a little bit disturbing. And the next resistance level above isn't that far, and it's bigger, right? More shares traded at that level. So it's hard for me to imagine the market taking off and running through all of that with all these other things that are going on as far as that goes. So the last piece is that the next level of high support is 13% below where we are today. right? So we got kind of a gap in the support level. And that support actually that I'm showing right now goes back to October, September of 2020. We hit some lows there before the election and kind of churned up a lot of shares. And so, if it falls lower, it could go to that level pretty easily. So again, sitting on the edge of the cliff, it's time to be a little bit careful. This is not my normal presentation because I normally feel very strongly about staying in, especially prior to recession indicator and the market showing some of these deterioration signs, which we've had the market deterioration signs all year. We haven't had the recession indicators at the level that I'm willing to act on as far as that goes. So anyway, that's what's happening so far. Hopefully, that helps understand, what I see in the economy, what I see in the stock market right now, and kind of what we need to do to kind of deal with this. You can take advantage. We did some of these things in 2000 and 2008, for example, of these down markets, and you can certainly try to protect yourself. So your recovery time isn't so long. That would be my main objective at this point, is to kind of shorten up recovery time when the market does turn around, which I feel probably will be when the Fed turns around and starts to be more supportive, at least in their verbiage and their rhetoric, if not actually easing, on those rates and whatnot too. So, those are things we'll be watching for as far as that goes. So anyway, thank you for watching this week. Look forward to talking to you and see what's going to happen next week. This is an exciting time to be paying attention. All right, Ethan, we've got some questions that we can deal with.
Yeah, so the first question is related to the market. What is a bear market rally, and how do you tell the difference between a bear market rally and just a regular rally?
Yeah, we got this question earlier, so I've got some things prepared for this too, but it's really fascinating because, first of all, some definitions, right? A bear market is a down market. Theoretically, it is down 20% or more, right? But people use it all the time for just down market. So it kind of depends on who's saying it. Right now, we're over 20%. We're technically in a bear market. So down, bull is up, right? And so what happens is then the major trend and the minor trend. That's how I look at it. Major trend is down. Minor trend are these little pops back up and coming back down, right? So I'll show you an example here. Here's a chart of the S&P 500 as denoted by the SPY ETF. I put some little yellow lines in there for some of the little rallies we've had. So obviously the overall downturn is the bear market. It's the major trend is down. And matter of fact, one of the indications for that is, number one, being below the 200-day moving average, and number two, having the 200-day moving average coming down. To me, that denotes a downward market, okay? And so these little rallies have been bear market rallies, right? Because they haven't turned into a full recovery. They've all failed, right? And market has gotten lower after those rallies. There's 4 big ones, including the one we're in right now. Now, one of the fascinating things about this, one of these bear market rallies will be the one that gets us all the way back, right, to the top. And it's very, very difficult to tell which one it is. I remember in the 2008 downturn when the market bottomed out March of 2009, it was a very dark period. Economically, things were really bad, and the market bottomed out in the middle of that. That's normal. So you really have to watch for certain things. Number one is, in my opinion, like fighting through resistance. So here we go. We have this green, blob on the side here, which is a volume profile. The longer that bar is, it means more shares traded at that price. And so the market's already fallen through that yellow line, is now trying to fight back through it. And it's going to be difficult because a lot of people bought at that price and it fell, and they want their money back when it gets there, right? So that's why it's resistance. And so in a true recovery, and not just a bear market bounce or bear market rally, you'll see the market fight through multiple levels of resistance. And so that would be something to watch for. Does it make it through this one? One of the other things that I would watch for is some volume, at least eventually, right? If the volume stays down during the up portion, it's just not enough energy and power to kind of get things going. as far as that goes. So we're not seeing that yet. It is a 4-day week, so maybe that's the culprit. So let's see what happens next week. I mean, next week, having it fight through this resistance, having volume pick up, that'd be a good sign. I mean, it really would be that things are moving, in the right direction. And so, because the next, resistance level is up here.
Yeah.
So you break that first resistance level, you get into that second resistance level, you could really, see a recovery. So bear market rally is just a rally that kind of fails in a downturn, an upward rally that fails in a big downturn and ends up at a lower low, right? And a recovery is when that finally turns around. And a true recovery gets all the way back up to a new high, right? Which, if you look back there, was in January, second trading day of the year. And so, anyway, that's what it is. That's how it works, and that's how to watch for a recovery. Right now, as we sit, I don't see it, right, personally. But, we're all data dependent. We all have to wait and see kind of what happens, what transpires, and, react to that to a large degree. I mean, we can guess here, it's going to go lower, it's going to go higher, what have you, but it's better to have kind of some historical data that you can look at and look at what's happening right now and have some comparisons. So,
do you think if we had some good economic data next week, could push the market to kind of break that resistance and have it continue the run?
Yeah, it could. I think the biggest issue, and I don't think there's much happening next week from the Fed. The inflation number, when we get those, and then the wording from the Fed, I mean, they just keep coming out. And I mean, even just this last week, we had interviews and testimony. The word recession was mentioned the most I've seen so far this year, but by Fed governors or by Chairman Powell himself, as a possibility, talking about how difficult it will be to bring down inflation because of the outside influences. So that's the problem, that I would love to see some of that change, because we've had these rallies. If you go back and look at these tops that we've had in these bear market rallies, most of them have been extinguished by either the Fed themselves, what they've done that was a surprise, what they've said, or inflation numbers coming out that's making the Fed do, things that are more surprising, like doing a 0.75 point increase instead of a half because of the CPI number that came out, a couple of Fridays ago, right? So but I'll tell you what, that's how the market works. I mean, you can make all the arguments you want. It can climb a wall of worry. It can come all the way back. And most recoveries, and I call it the anatomy of a recovery, it starts with the market overextending to the downside, which you definitely see in that chart. That's a cascade, a waterfall that happened. And it kind of gets all the sellers out. It brings in some buyers, right? The only ones left. Doesn't take that many. Volume can be low. And boom, boom, you get this motion up. And then pretty soon all the hedge funds that are shorting, the market to death because the market's going to fall farther, they have to start covering those shorts. That becomes buys, right? And if they cover, they buy, and the market keeps going. So sometimes short covering short positions right now, according to articles I've read, are as high as they've been since 2008. So very high. And so then you start to get this kind of fear of missing out, right? FOMO. And so people just start pouring in. And then eventually the institutional money has to come in to really make it go. Volume is picking up. And you get this scenario where, they can't miss out, right? I mean, I compare myself to the Vanguard Total Stock Market Index, for example. And so, if I have lots of cash, which I do right now, and lots of ultra short-term bonds, which I do right now, I'm going to lose to this thing if it takes off. And eventually, at some point, I have to get back in, and that money will dump back in with everybody else. That's a recovery. That's how it works. But what we've seen so far, just in my opinion, is that when we get these big runs, the institutions aren't coming in. We're not seeing the big volumes on the upside. I think, they're very, very attuned to the Fed. And they don't want to fight the Fed. That's a very common saying. And they don't want to be, on the other side, the Fed is hammering and hammering and hammering. They want to wait until that point when the Fed starts to at least, get a little bit softer, or at least they can see that it will happen, right? At some point in the future, the market does look forward. it's hard to look real far forward right now with what's happening, but it's definitely possible. We could have set the bottom last week,
Yep.
so we'll see. So that's a good question.
So our next question is more of a kind of a planning question. I'm heading into retirement. Should I consider downsizing if I have a larger house that is bigger than I need? My kids are have graduated. They've gone off and started their own lives, and they don't need to come back to their rooms. Or will I? And the idea is, will I regret downsizing in the future?
Yeah, it's a good question. We've had a lot of clients move. One thing about being in Silicon Valley is that the house prices, went really high. And so people have cashed out and moved somewhere. And sometimes that was downsizing. Sometimes it was same sizing, different location. And sometimes it's actually upsizing, usually different location. And so it's really interesting. It's very personal, right? I mean, from what I've seen as a whole, some people are very, very happy to get back to a smaller space, just from a maintenance standpoint, from a cost standpoint. If you go to independent living or assisted living, those are all like 1-2 bedroom apartments and such. So it can be difficult because you've accumulated. I mean, you spent your whole life, especially if you're successful financially like our clients are, you spent your whole life basically upsizing and filling that space with a nice dining room set or whatever it was that you really liked. And then all of a sudden you're moving down, and so it can be very difficult to decide what to get rid of and just the thoughts of that and what have you. So that's a personal thing. You have to trade that off. You're going to trade off kind of the space that you have and the things that you have for something smaller. And the big benefit is less maintenance, less cost oftentimes, because that can be really onerous, right?
Yeah.
I mean, I'm constantly working on my house. There's just something happening. I mean, they're in a state of decay like every day, essentially. That's one thing I didn't realize. The American dream of buying a home is still great. I'm very happy I have a home, but and I would encourage everybody to have it. But I didn't realize how much effort it is to keep them, keep them going and making them look nice.
Yeah, and I think a lot of people have that issue is when we have space, we fill it up.
Yep.
When we have it, I cleaned out the garage and it's filled back up again with stuff.
Yeah.
It just happens. We accumulate things.
Yep.
And so when you downsize, are you giving up something? And another thing is, how often do your children visit? Or do you have grandchildren? And do you want them staying with you for a summer?
Right.
Because that's what I did. Over the summer, I went to my cousins and I stayed up there, but they had enough space for me.
Yeah.
But if you downsize, do you have enough space for that? So that's another thing to consider is lifestyle. Is your family going to be able to come here, or do they have to rent somewhere else? But another thing that my family also did is, whenever we have a really big get-togethers, we usually go and rent a house or rent 2 houses close by together, and then we go to and just have a vacation there. Because the thing is, you don't have to worry about cleanup, you don't have to worry about all those kind of issues with that big house, but you could still enjoy it as a family.
Yeah, so that's exactly right. So if you moved into a 2-bedroom condo or something and you were in a 4-bedroom house, you got to figure out what to get rid of and what have you. And if your family still wants to come, they're alternatives, right? I mean, that obviously you still have 1 bedroom or some room if a small group of the family comes, maybe that works. But if you want to get more of the family together, there are hey, you go rent places, you set up, put somebody in a hotel. I mean, there are ways to handle it as far as that goes. But I have had clients go the opposite direction. I've had clients go from 4-bedroom house to 6-bedroom house. Mainly because their children had grown and had grandchildren, and they wanted a location to get people back to this home and hearth that they've designed to develop really around this whole event of having everything come back. Because it's like of all the things they do and all the travel they do, the most fun thing that they have going on in their life is having their kids come back with their grandkids all at once, have Christmas, whatever it is. And so it's sort of an investment in that portion. Again, that's what makes it personal. I mean, how big is your family, right? I mean, and how does that matter? I've got another client who they have gatherings that's 30 people. Oof. And now they're putting them all in a small house. Now they're not staying there, but they gather for Easter, Thanksgiving, Christmas, for example. And they have a really great tradition. They play these great games. It's really, it sounds like fun. I mean, they have a great time. But if they were to downsize to, say, a 1 or 2 bedroom apartment or something, they probably wouldn't even be able to do that, right? At least in their existing place. So it does matter as to what's important to you. Is your stuff important to you? Is having your family all together important to you? Are you willing to, basically set that up in some other way? What's your financial situation like?
Yeah.
Right? I mean, so if you're going to end up really suffering financially to keep your house because of the maintenance and what have you, and you've got some equity in it that you really need, then maybe a reverse mortgage is an option. Those are problematic in a lot of ways, but it does allow people to stay in their homes for periods of time. Or you move someplace else that's cheaper, buy that same size place, right? So I've seen clients do that. So it's a really good question. There isn't a spectacular singular answer because it makes really a personal decision that you have a situation that is unique, at least to you. And so making those decisions and looking at and being very honest with yourself about what's the most important, right? And then trying to make that happen. And life is short. Have fun. All right. What else do we have?
So this is another market question or planning/market question. My portfolio is down. Should I ever consider taking Social Security early as income to kind of make up for that decrease in my portfolio?
Okay, so portfolio is down. Obviously, that's true for most of us here in this particular market. And I'm assuming that means that we're withdrawing some money from that account to live off of. We're retired. Maybe we're not at full retirement age yet, where we can, get our full Social Security. Let's just say we're 63 or 62 or something, so we could take it. So should we take Social Security and take the pressure off the portfolio, or just keep doing the portfolio and let Social Security grow, right? It's actually a math problem. We can put this exact scenario into the financial planning program, run the Monte Carlo simulation, and be able to see which scenario works the best. We can try different ages for Social Security. We can try different, concepts for what's going to happen for the portfolio and how much you're withdrawing from the portfolio, right? I mean, you can solve this. We can actually answer this with, Monte Carlo simulation. I guess another way to look at it would be just in terms of withdrawal rates. So let's just say, for example, you're taking 4% out of your portfolio right now before the market started down. Now the market's down, you're up to 5 or 6%, depending on what's happened with your portfolio. And that's a pretty big drawdown. I mean, you are really hurting that portfolio at those levels, potentially. And if maybe Social Security would help to reduce it back to that 4% level again, filling that gap. If on the other hand, let's say you were only taking 1 or 2% of that portfolio and now the market's dropped and you're up to 3%, you might be better off letting Social Security grow. As you know, Social Security has a full retirement age.
Yep.
Right now, for a lot of people, it's 67. If you take it at 62, you basically get it discounted. In other words, you get less. It's a penalty. It's an exact percentage. Every single month that goes by, your Social Security is growing to that value that you get at Social Security, right?
Yep.
I'm sorry, at full retirement age. After full retirement age, from 67 to 70 in this case, then you get an 8% increase guaranteed on your Social Security, plus you get any cost of living increases that happen. That's really healthy. I mean, last cost of living increase was 5.9. The rumors are it'll be higher this year coming up for 2023, plus 8% growth. You'd be missing out on that if you took it earlier. I'd probably only do that if the math said to do it, or my withdrawal rates are really high and I was really damaging my portfolio, because I'd rather have that Social Security grow, because it's a guaranteed income. The next time we get into a downturn, I want to have the most I can from Social Security coming in, instead of having taken it earlier because of a downturn that turned out to turn around and come back, and now you're kind of stuck. I mean, you can start if you within a year, you can actually go back and do over your Social Security, but you got to pay all the money back. I've never seen anybody do it.
Yeah, it's rough because if you usually you take Social Security because you need to take it,
Yep.
and so paying back that a year
Right.
worth of benefits is
Right.
really rough.
Where's that coming from? If you had that already, you might not have taken it early.
Yeah, you could get lucky in the market, could just skyrocket for
Yeah,
a year, and
yeah.
maybe then you could liquidate
Right.
some of your assets, but
Yeah,
it's kind of unlikely.
Yeah.
And so the idea is, do you give up that 8% guaranteed growth? I don't think if you told me there's an investment out there that can give me 8% every year for 3 years, I'd take that in a heartbeat.
yeah, I know. It's almost a 25. That's a 24% increase. It's compounded for that matter. So I mean, yeah, it's really. I think that's pretty nice. But again, it is unique. Each person has a different situation. There might be a scenario where you should take it. Your withdrawal rate is too high. We run that through Monte Carlo simulation. We'd be able to see Social Security works better. Taking Social Security now works better, right? Versus it doesn't. Yeah, and so that we can play with that. We can try out different scenarios, and it's essentially a math problem.
Yep.
And so it can be solved. There's always the emotional aspects and kind of what you're trying to do, and that does kind of trump the math, right?
Mhm.
The logic is not as strong of a thing as the emotion, so you've got to account for that. But the question is pretty straightforward as far as that goes. But the answer, it depends on your situation. And I'd certainly be looking at withdrawal rate for starters.
Yeah.
If you have a high withdrawal rate percentage, then maybe take Social Security. If you don't, maybe not. And if you really want the right answer, call us, set an appointment, and we'll do the Monte Carlo simulation for you and figure out what the real answer is.
Mm-hmm. So our next question is, I want to help fund my grandchildren's education. What are some of my options, and what are the pros and cons to each option?
Yeah, this is my 35th year, and I have a different answer now than I used to have, just based on personal experience. There are all these vehicles that you can save for somebody's education, right?
Mm-hmm.
And they're great, actually. My favorite vehicle, the one that seems to be the most popular right now, is the 529.
Yep.
Right? So in some states, you actually get a write-off for putting money in a 529. Not true in California, unfortunately. But every place, it grows tax-free,
Mm-hmm.
right? And you can buy any state's 529 plan. Every state has different 529 plans. Some of them have multiple 529 plans. So you can go out and shop and find really good ones and what have you. So the problem is that in order to really be effective in planning for college savings, you probably should start pretty young, because the whole object is to let compounding growth happen over a long period of time, so that maybe you put in a certain dollar amount, but it's worth a lot more, and the rest was just earnings. You gained it. If that child's 16 and now you're going to start saving for college, nothing wrong with that. But you got a couple years, and maybe you could add on the other 4 years in total. They might be in college, but pretty short period of time for compounding. So if you're going to be starting early, here's the catch. The catch is you don't know what they're going to do.
Mm-hmm.
I got a 2-year-old or a 3-year-old or a 5-year-old. Are they going to go to college? Are they going to get some kind of scholarship? My son got a golf scholarship, so that reduced the cost. I wouldn't have said that was true when he was 2 or 3, although he did start playing when he was 3, so maybe. But nonetheless, and so we've got these situations where I've had several clients who actually oversaved, and they have quite a bit of money in 529 plans and other retirement plans, and the kids haven't used it. They went to a school that wasn't that expensive, that kind of thing. So the answer, in my opinion, now that I've been through this and watched this, is to kind of split the difference. Put money into a 529 plan, because the reason, again, is because you can't get that money out without it being a college cost. There are some things you can transfer to other people in the family. It's the most flexible of the college plans that I know of. But what if they don't go to college, or it doesn't cost that much, and you want to help them with the down payment on a house instead? Well, you got all this money in the 529, you're going to get killed on taxes trying to take that out. So maybe split the difference. Set up a separate account, just a regular brokerage taxable account that, kind of half and half, 529 and regular account. And because you can still use the regular account for college. It's not tax-free growth, but it is capital gains growth, which is not bad. And then you have both. And if they go to college, you have both to use. If they don't go to college, then you can really use that other one for something else. You could even use it for yourself.
Yep.
Maybe you end up remodeling, some portion of your home or something, but you can also then, help your kid get a home or, whatever it is that you're trying to accomplish there. So anyway, that's just from personal experience. If you're only going to save a small amount, and it's going to definitely be below any cost of college, then just do the 529.
Yep.
Right? But if you're really trying to do it, then you're going to try to kind of maximize that. And I've seen a lot of families getting involved. Grandparents are putting money in, and it's awesome, right? I mean, everybody's supporting these kids, and I think that's fantastic. But the structure of that needs to be thought about, just in case so you don't end up with, your kids are out of college, you got all this money at 529. What do you do with it? Maybe you wait for your grandkids.
Yeah.
But you don't know if that's going to happen, right? I mean, it's interesting. It's a good question.
Yeah, and so like some of your other options are you have UTMAs, which are Universal Transfer to Minor Act, and you have Cordell accounts and like these education savings bonds. They're called EE bonds. And so these are some of your other options. Most of the times people recommend the 529 over these options is Cordell's and savings bonds, you can only save a limited amount, and savings bonds don't really pay as much as kind of being in the market. So if you're going for a long term, those bonds kind of fall behind. And so the reason that people have kind of gone away for UTMAs is it's the ownership. When you look at age of majority, this asset transfers to the child. And so if it's 18, then your child ends up with whatever money's in that UTMA. So if you have $50,000, that could go to them. How they decide to do with what they do with it is their choice. You lose control. And so that's the nice thing about 529 is you retain kind of that ownership of it and you can control it. And so when it comes to, I guess, in later ages, say you're a non-affluent family and you might qualify for needs for your college. And so 529s are more beneficial because they count as your parents' assets. So any asset that your child has, 20% of it can be considered usable for a year of college. And so they would expect you to liquidate 20% of your assets for that year. And that would be considered what you can contribute. While a parent can only contribute about 5 to 6%. I don't know the exact, but it's in that range. And so that's a much smaller. And so 529s count as your parents' assets. So if you're trying to qualify for needs, you want to have it in a 529 versus a UTMA.
Yeah, I would say that most of the other UTMAs and all of these things, most of those that we see that are in the practice were established before the 529, came out. And so really it's just, the 529 is kind of dominated because of all the flexibility. And they've actually continued to increase the flexibility beyond just college. They've made, you can spend it on more things like the laptop that you use in college. You can spend it on private school, K through 12 private school. And so, if you think your kid's going to go to a really expensive high school or something along those lines, you can start saving at a younger age for that too. So that's interesting. I mean, and that ownership piece is a big deal. You don't want to put $50,000 into, an account that your 18 or 21-year-old, depending on the majority age of the plan, is going to get. And, you hope that they'd spend it on college, but it could go to a Corvette. So, I don't know, maybe that's all right too. But nonetheless, that 529 plan allows you to kind of control that and redirect that money to somebody else if they don't go to college, or redirect it even to one of your other kids, which I think is really cool because I have two kids, one who went to a UC school here and had scholarships, so it wasn't super expensive. Another child that's going to a small private school that's more expensive, and so I could redirect 529 assets towards the more expensive child which so it just gives me some flexibility. You can't do that with those other types of accounts
Yeah,
as
and
easily anyway.
I think Congress is aware that 529s need to get better to incentivize people to save. And so, they realize that not everyone goes to college. And so certain trade schools, if you're a accredited trade school, you can you can get that, your 529s can pay for that.
Yep.
And those are worthwhile jobs for a lot of people.
Yes, yeah, exactly. No, it's great actually, and tax-free growth. We use a plan called My 529 through Utah, for example, is one of our favorites. I can get a hold of Vanguard funds inside of there and create nice portfolios, and the internal costs are reasonable. You got to watch out because some of the states are really expensive in terms of the internal costs. So you got some selection there. It's a great concept, and I enjoy working with those actually.
Yeah, and another thing about 529s is instead of actually just having an investment account, if you're trusting that your kid will go to a certain school, you could prepay tuition. And so I know it's very popular in Florida. A lot of people end up going to Florida State or Florida University because they have a really cheap prepaid tuition system that's really worthwhile.
Yeah, probably a lot of alumni hoping their kids go there, and it's paid for, so it kind of self-fulfilling prophecy, I suppose. But so that's our show today. Really excited that you were able to join us today. Hopefully there was something here that helps you move along with your financial decisions, your retirement decisions, and what have you. Again, we have 900 plus videos on this channel. You can subscribe and basically hit the bell to get notified when we get new videos going on there, or you can book an appointment with us if you'd like. Again, go to the website, hit the book appointment button, 30-minute, half hour of time with Ethan and I on video or phone. We would love to be able to chat with you also. So thank you for coming today. Look forward to talking to you again next Friday. Thank you very much.